Smart money management strategies for beginners. Have you ever received your paycheck and wondered where all my money went? You pay your bills. You buy groceries. You use your credit card. You order food. You pay subscriptions. You make a few unexpected purchases. And before you know it, another payday is approaching, and your bank account is almost empty. The problem isn't always how much money you earn. Sometimes, the bigger problem is how you manage the money you already have. In today's video, we're going to explore 10 smart money management strategies for beginners that can help you control your spending, organize your cash flow, reduce financial stress, save more effectively, manage credit responsibly, and make smarter financial decisions. Welcome back to Credit Secrets Lab. Let's get started. 1. Give every dollar a job. One of the smartest money habits you can develop is to stop treating your income as one large pool of money. Instead, give your money for specific jobs. For example, imagine Emma earns $3,500 per month. Instead of simply spending from her bank account, she divides her income into categories: housing and essential bills, food and transportation, savings, debt payments, investments, entertainment, personal spending. Now she knows exactly what her money is supposed to accomplish. This is called purpose-based money management. When every dollar has a purpose, you're less likely to spend money impulsively. 2. Use weekly money check-in. You don't need to spend hours analyzing your finances every day. Instead, create a simple weekly check-in. Choose one day each week and spend 10 to 15 minutes reviewing your bank balance, recent transactions, credit card spending, upcoming bills, savings progress, and debt payments. Here's a real-life example. James earns a good income, but he rarely checks his bank account. One day he discovers that several small subscriptions have been charging him every month. He also realizes that his restaurant spending has increased significantly. Nothing looks serious individually, but together, those expenses were costing him hundreds of dollars each month. A short weekly financial review could have identified the problem much earlier. 3. Separate needs from wants. One of the most powerful money management skills is learning the difference between needs and wants. Needs are expenses required for basic living. Wants are things that improve your lifestyle but aren't essential. For example, rent is usually a need. Groceries are a need. Basic transportation may be a need. But expensive restaurant meals, the newest smartphone, designer clothing, and multiple streaming subscriptions may be wants. You don't have to eliminate every want. The goal is to spend on wants intentionally rather than automatically. Before making a purchase, ask yourself, do I need this, or do I simply want this right now? That one question can prevent many unnecessary purchases. 4. Create a waiting rule for big purchases. Impulse spending can destroy a budget surprisingly quickly. One simple strategy is to create a waiting period for non-essential purchases. For example, wait 24 hours before buying something for over $50. Wait 72 hours before buying something expensive. During that time, ask yourself whether the purchase is worth the money. Imagine Lisa sees a $500 product online. She wants it immediately. Instead of buying it, she waits 3 days. After 3 days, she realizes she doesn't really need it. She keeps the $500. That money can now be used for savings, debt repayment, investing, or another financial goal. Sometimes the best financial decision is simply not buying something you don't need. 5. Build sinking funds for predictable expenses. Many people call predictable expenses unexpected expenses, but they're often not unexpected at all. Car insurance, annual subscriptions, school expenses, holiday spending, property taxes, vehicle maintenance, birthday gifts. These expenses happen regularly. That's where sinking funds can help. Suppose your annual car insurance costs $1,200. Instead of finding $1,200 when the payment is due, you could set aside $100 per month. After 12 months, you have $1,200 ready. This turns a large financial shock into a manageable monthly expense. 6. Automate your financial life. One of the smartest financial strategies is automation. Set up automatic transfers for important financial goals whenever your banking system allows it. For example, on payday, money goes toward essential bills. Money moves into savings. Money goes toward debt repayment. Money goes toward long-term investments, where appropriate. Then you use the remaining amount for lifestyle spending. Automation reduces the number of financial decisions you need to make. And when savings happen automatically, you're less likely to accidentally spend the money first. 7. Use credit cards as tools, not extra income. Credit cards can be useful financial tools when managed responsibly. But a credit card is not additional income. If you earn $3,000 per month, spending $4,000 simply because you have a $4,000 credit limit doesn't make you wealthier. It creates debt. Let's say Mark uses his credit card for everyday purchases, but regularly spends more than he can comfortably repay. Interest begins accumulating. His balance grows. Eventually, he is using future income to pay for past spending. A smarter approach is to understand your credit limit, monitor your balance, pay on time, and avoid carrying expensive revolving debt whenever possible. Your credit card should support your financial plan, not control it. 8. Create a personal spending limit. A budget tells you what you plan to spend. A personal spending limit tells you when to stop. For example, suppose you decide that $300 per month is your discretionary spending limit. That could cover entertainment, restaurants, hobbies, or other non-essential purchases. Once you reach $300, you stop discretionary spending until the next budget period. This creates a simple financial boundary. You don't need to track every penny forever, but you do need to know when your spending is approaching a level that could damage your financial goals. 9. Increase your savings rate gradually. Don't think that you need to save a huge percentage of your income immediately. Start with a realistic amount. If you can save $50 per month, start with $50. Then perhaps increase it to $75. Later, $100. If your salary increases, consider directing part of the increase toward your financial goals before increasing your lifestyle. For example, if you receive a $400 monthly raise, you could put $200 towards savings or investing and use the other $200 for lifestyle improvements. This helps prevent lifestyle inflation, where your spending rises every time your income rises. 10. Create a money priority ladder. Not every financial goal should have the same priority. A simple financial priority ladder can help. First, cover essential expenses. Then establish an appropriate emergency savings cushion. Next, focus on expensive debt. Then work toward important medium and long-term savings goals. After that, consider appropriate long-term investing based on your circumstances and risk tolerance. The exact order can vary depending on your income, debt, country, financial goals, and personal situation. The important idea is this: don't let every financial goal compete for your money at the same time. Give your money a clear priority. Real-life example. Let's put these strategies together. Imagine Daniel earns $4,000 per month. Previously, he spent money without a plan. By the end of the month, he had very little left. He decides to change his system. He begins tracking his spending. He cancels unused subscriptions. He creates a weekly money check-in. He establishes a monthly spending limit. He creates sinking funds for predictable annual expenses. He automates savings. He stops treating his credit card as additional income. And every time his income increases, he increases his savings rate. Daniel doesn't become wealthy overnight. But something important changes. He becomes intentional with his money. And that's what smart money management is really about. The smart money management formula. Let's quickly review the 10 strategies. Number 1. Give every dollar a job. Number 2. Have a weekly money check-in. Number 3. Separate needs from wants. Number 4. Use a waiting rule for major purchases. Number 5. Create sinking funds. Number 6. Automate your finances. Number 7. Use credit cards responsibly. Number 8. Set a personal spending limit. Number 9. Increase your savings rate gradually. Number 10. Create a financial priority ladder. You don't need to implement everything today. Choose 2 strategies. Start there. Once those habits become automatic, add another. Remember, smart money management isn't about never spending money. It's about making sure your spending supports the life you actually want. Your money should help you pay your bills, handle emergencies, reduce financial stress, achieve important goals, and create opportunities for your future. The goal isn't to become obsessed with every dollar. The goal is to become intentional, organized, and financially confident. So start today. Check your bank account. Review your recent spending. Cancel one unnecessary expense. Set one savings goal. Create one sinking fund. Or establish your first weekly money check-in. One small financial improvement can lead to another. And over time, those small improvements can completely change the way you manage your money. If you found this video useful, subscribe to Credit Secrets Lab for more practical videos about credit cards, credit scores, money management, budgeting, saving money, debt management, investing, and smart financial strategies. Turn on notifications so you don't miss our upcoming videos. And leave a comment below. Which smart money strategy are you going to start using first? Thanks for watching Credit Secrets Lab. Subscribe, stay informed, manage your money wisely, and keep building a stronger financial future.